Welcome back to Investing Talk podcast.
It is great to be back.
So usually we're sitting here breaking down, the latest tech darling or maybe a retailer that's trying to turn things around.
Right, something you can sort of analyze with normal metrics.
Exactly. But today feels a little different. We're looking at something that has been described as a widowmaker trade.
That's a strong word.
It is. It has absolutely incinerated capital for people who held on too long. But, and this is the key, it's currently flashing a massive short-term signal.
It really is. Today we're looking at BAL, the ProShares Ultra Bloomberg Natural Gas ETF.
BAL. Even the ticker sounds volatile. As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps the algorithm know we're providing value.
It really does.
Yeah.
So let's unpack this thing.
Let's do it. First off, what is this? I mean, if I buy a stock like Apple, I get a piece of a company. I get earnings, revenue. What do I own if I buy BAL?
That's the most important question. And the answer is, you do not own a gas company.
Yeah.
There are no drilling rigs, no pipelines.
No land in Texas.
None of that. BAL isn't a company at all. It has zero earnings, zero revenue.
Sounds like a terrible business.
Well, it's not a business. It's a tool. It's a leveraged commodity ETF. Its whole purpose is to track 2 times the daily performance of the Bloomberg Natural Gas Subindex.
2 times. So if gas goes up 1% in a day, BOL, in theory, goes up 2.
Exactly. And if gas goes down 1, BOL goes down 2. It does this by holding natural gas futures contracts. Right now, it's the March 2026 contracts.
So it's a derivative play. You're betting on paper, not the actual molecules.
Precisely.
Okay, let's look at the price. As of January 16th, it's sitting at $16.42. And its net asset value is right there with it. So no weird premium.
Nope. Trading right where it should be based on its assets.
But here's where, the skeptic in me starts to get nervous. I look at the chart, and year to date, it's down 34.1%. And the one-year return is negative 22.7%. I mean, on paper, this looks like a money pit. Why are we not running away from this?
Because with commodities, especially leveraged ones, that long-term rearview mirror can be really misleading. Momentum is everything.
So what's the momentum telling us now?
Well, you have to zoom in. Despite that horrible yearly drop, in the past month, the fund is up 9.07%.
Whoa, okay. That's a sharp reversal.
It is. And just in the last week, it's up over 7%. That's what we call a near-term momentum reversal. The bleeding stopped.
And it's not just the price, right? What about the money flows?
That's the other part of the story. The fund's AUM is around, say, $600 million. But here's the kicker. Despite those awful yearly numbers, it's seen net inflows of over $100 million in the last 12 months.
Wait. So while the price was tanking, institutions were pouring $100 million into it.
Yeah, that's what the data says. Retail investors panic and sell. But institutions, they see a discount. They see an opportunity. That's smart money getting into position.
So they're loading the boat for a bounce.
They're loading the boat. And the fund itself is healthy. It's holding about $680 million in cash to manage that 200% exposure. It's not going to implode.
All right, so the big money is betting on a comeback. Now, looking at the charts and technicals, what's the actual setup here?
This is where it gets really interesting. There's a setup that was identified back in November that's basically playing out perfectly right now.
Okay, break it down for me in simple terms.
Think of the price like a ball bouncing down a hallway. It's been hitting a ceiling, then a floor, a ceiling, a floor. We call it mid-channel oscillation.
And right now?
Right now, it just bounced off the floor hard, and it's heading back up toward the ceiling. We're trying to catch the bounce.
So what's the potential of that bounce? Give me the numbers.
Okay, so there's a specific signal analysis that's pointing to an exceptional risk-reward setup.
Exceptional, I like that word.
The technicals are targeting a potential 57.8% gain.
57?
Yeah.
Wow. That is aggressive. What's the catch? What's the risk?
And this is the crazy part. The calculated risk, because we're so close to that floor, is only 0.3%.
Hold on. You're telling me there's a potential 57% gain versus a 0.3% risk. That can't be right. How is that possible?
It's not a guarantee. It's about trade structure. The floor, that support level, is a line in the sand. If the price drops just 0.3% below it, the whole thesis is broken.
Ah, okay. So you get out immediately. You pull the ripcord.
Immediately. You have to be disciplined. The 0.3% is your signal to exit, not the maximum you can lose if you're stubborn. But if it bounces from here, the runway is wide open.
I see. It's about the asymmetry. So Is it liquid enough for that? Can you actually get in and out that fast?
Oh, absolutely. The volume is huge. We're talking about 11.5 million shares traded daily.
That's a ton.
It is. And the bid-ask spread is super tight, like 0.05%. You can get in and out instantly, which, for a trade like this, is absolutely critical.
Moving on to what the market is feeling in sentiment. Are people actually buying this story?
You'd be surprised. The quantitative score is an 80% positive sentiment ratio.
80% for something that's been crushed all year.
Yeah. 4 out of the last 5 major articles are bullish. There was one headline in particular: Boyle affects rotational strategy timing. That tells me portfolio managers are actively rotating money out of other sectors and into energy for this exact play.
But why? What's the real-world catalyst? It can't just be lines on a chart.
It's a perfect storm, really. 3 things. First, and most obvious, is the weather.
It's cold, sure, but is it that cold?
We're talking severe winter forecasts, polar vortex stuff for late January and February. This isn't just chilly. This is the kind of cold that spikes heating demand to emergency levels.
Okay, so peak heating demand, what's number 2?
Geopolitics and supply. You have disruptions globally, and here at home, drilling restrictions have kept supply tight. You can't just flip a switch and get more gas.
So demand is spiking and supply is constrained. Makes sense. And the third driver?
Exports. The U.S. has become the world's gas station. We're seeing headlines about record LNG flows to Europe and Asia. Plus, there are worries about tariffs on Canadian gas, which makes U.S. gas even more valuable.
So every angle. Domestic demand, export demand, tight supply. It all points up.
It's a textbook setup for a price spike.
But I did see one bearish article, something called Boyle ETF. Playing with fire, what's their take?
And that's a great point. But if you read it, their warning isn't about the now. They aren't saying the price won't pop. Their argument is, don't hold this long term.
So their fear is about the structure of the fund itself.
Exactly.
Yeah.
It's about leverage decay, which is the perfect transition.
Yes. We have to talk about the dangers in the risk section, because this is where that Widowmaker name comes from.
This is the most critical part of this conversation.
So you mentioned it holds futures contracts. Explain why that makes it a melting ice cube.
Okay, so imagine every month you have to sell the contract that's about to expire and buy the next month's contract.
Right, you have to roll it over.
But often, the future month's contract is slightly more expensive than the one you're selling. It's a phenomenon called contango. So every single month, you're selling a little low and buying a little high.
You're losing a tiny bit of money on every single transaction.
A tiny bit that adds up. It's called roll decay. It means that even if the price of natural gas stays perfectly flat for a year, Boyle will go down.
That's the trap. What are the numbers on that decay?
The annualized return over the last 10 years is negative 41%.
Negative 41 every year. That's just mathematical wealth destruction.
It is. This is not something you put in your retirement account and check in a decade. This is not a nest egg stock.
Not at all. And what about the outside risks? What if the weather forecast is just wrong?
That's the big macro risk. If we get a surprise warm spell in February, or if some geopolitical tension suddenly eases, the price of gas could fall off a cliff.
And with 2x leverage, a cliff dive for gas is a double cliff dive for BAL.
Precisely. If gas drops 10%, you lose 20. Fast. A stop loss isn't optional here, it's mandatory.
So what's the time horizon? How long is this trade viable?
It is strictly a 3 to 6 month trade, max.
Get in for the winter and get out when?
You have to be out before the spring shoulder season. Once we hit March and April, heating demand plummets, and that contango, that decay, will eat any profits you have left. If you're holding this in May, you've made a mistake.
Okay, so let's bring it all home. The verdict. What's the final score on this thing?
Taking everything into account. The strong technicals, the momentum, the sentiment, but also the extreme risks. I'm giving BIL a bullish score of 7.2 out of 10.
7.2, that's a pretty strong conviction. So the elevator pitch.
BIL is a swing trade into spring 2026. It's a pure tactical play on winter heating demand and record LNG exports. It's about catching this specific seasonal rally.
And my final warning to go with that, it's a rental, not a purchase. Date this stock, do not marry it.
That's the perfect way to say it.
You marry this thing, it's going to take half your portfolio in the divorce.
It's a tool for a specific job. You know, it's like a chainsaw. Incredibly effective for what it does, but you do not want to be careless with it.
Don't juggle chainsaws. Got it.
Please don't.
All right, that's the verdict on BOIL. If you enjoyed this breakdown, make sure to hit that subscribe button.
We'll see you next time.
Thanks for listening.